we're going to be hosting monthly, just kind of highlighting updated programs, trends, things that you should know about. Because, you're talking to clients daily and they're asking questions about, the buying process, what programs are out there. And lately, our GSFA program has been a really popular one, especially on TikTok. So then I also kind of go what's trending when it comes to financing, what are clients looking at. And as you know, DPA has been like, ever since CalHAPA released their Dream for All program 3 years ago, it brought a lot of awareness to consumers about down payment assistance program and that they exist. So down payment assistance program does not fit everybody, but it does give, a advantage to a lot of people to get into homes quickly. It also for us should be a way to be in front of our consumers and letting them know that there are options for them than just being a traditional, 20% down payment program. So if I think I know everyone that's chiming in today, but if there are someone that is new, um, I'm a branch manager here in the city of Downey with Emerald Mortgage. We are powered by American Pacific. American Pacific Mortgage is a nationwide company. And for you that didn't know, we could lend in any state in the country, even Alaska and Hawaii. So if we have anyone that's purchasing outside, let us know. There are specific down payment assistance programs for every state. And we are getting a lot of California residents relocating and moving out to other cities. We offer various down payment assistance programs. That's been kind of my bread and butter for over 2 decades. We focus on CalHAPA programs primarily. And of course, we have other programs like GSFA, LIPA, MIPA programs. Pathway is also a big down payment assistance program, Genoa funds, which is like a hidden jewel that people don't use, USDA loans as well. So we're going to be covering a lot of these programs throughout the year. We're going to change the topic every single time that we have a presentation. But today we're going to focus on GSFA. GSFA in the last couple of months have been the one topic that everyone is searching online, and it's because they've opened it up to everybody. By show of hands, who has closed a GSFA loan before with the lender? No one? Okay. So let's talk about some of the myths about down payment assistance programs. Often a lot of agents think it's only for first-time buyers. With GSFA, it is not. Okay. People always think they're harder to qualify. They're always, talk about it's only for lower income borrowers. They talk about, you only need perfect credit, that you can't buy it with a lower credit score, that is restricted to only one borrower. It's also, people think it's restricted to only, if it's your first home. With GSFA, it is not. People always think it's limited to certain areas as well. Some programs are, but about 80% of DPA programs is open to you purchasing anywhere in California. And then another thing, a big one, this comes from a listing agent perspective, is that it creates too much work for the listing. It creates too much work for the realtor to be able to submit an offer with using a down payment assistance program, right? And then also another myth is that it takes too long to close. So depending on the program, it may take a little bit longer, but most state of California programs like CalHAPA or GSFA or Pathway or Genoa funds will not take any longer than your traditional 21 to 30 days. There's nothing different about these programs. They all get processed the same way. They don't need an extra reservation. We don't need to wait for the funds to be available. We can wrap them up at the time that you're ready to get a loan approval. Okay. All right, what is new with GSFA? And this is why it's the most searched program online right now, including TikTok, because GSFA has had an exclusive promotion this last couple of months that is open to everyone. So typically GSFA programs are for first responders, nurses, school teachers, but for the last few months, it's been open to everybody. And the reason I think behind it is because it's not such a popular program like CalHAPA. We hear CalHAPA everywhere, especially with the Dream for All program. And to be fair, CalHAPA is doing a phenomenal, job and marketing, right? I mean, you see CalHAPA marketing with videos, on their Instagram page. They just done a great job and they're going to continue to grow. They just hired a third-party company that's also doing database managing, and they're tracking their consumers, they're tracking who's clicking on, who's inquiring, who's asking questions. So GSFA, CalHFA continues to grow with that. And unfortunately, GSFA is falling behind, and GSFA is as old as CalHFA. So now they're trying to see how else can we compete and how can we enter the market and have the ability to fund more loans. So this last few months, they've opened it to everyone. So for a limited time, and I'm hoping it's not going to just be a limited time, but it's also going to be for the remainder of the year or more, that it's open to everybody. So before, clients thought that they needed to be in particular fields to apply to this program, but now it's really everyone. Now, everyone, what I mean, we'll go over a little bit about what that means to GSFA, is that the grant part of the program is open to everybody. Before, it was just limited to certain positions. So what are the highlights for the program? So GSFA, it's very different than CalHFA. CalHFA, it's a deferred loan. GSFA, it's a repayable loan. So you do have to repay back the down payment assistant portion with your monthly payment. But here's some of the highlights with this program, is that you can receive up to 5.5% of your funds towards your down payment or your closing cost. And the way the 5.5% works, it gets split, right? And they use 5.5 because this is an FHA example. You can use 3.5% towards your down payment and 2% as the grant. The grant portion, there's no hidden secrets to that. There's no attachment. There's no prepayment penalties. There's no time that you need to live in the property like other programs that gives you grants. You need to stay for 5 years, maybe 30 years. This one, you can sell your home at any time. There's nothing attached to them. The same thing with the down payment assistance. You get refinance, sell the home, and there's no prepayment penalty. There's no time frame that you need to retain in that property. So that's one of the big things, is that you can get up to 5.5%. Now, why we say up to 5.5%? Because it's broken down in programs. It is also broken down, just like CalHFA, the more money you need, the higher the interest rate. Now, one of the things that is favorable with GSFA is that the interest rates, the more money that you receive, the interest rate does not jump up as high as our CalHFA ZIP program. For example, CalHFA ZIP program, the first mortgage today, if you just received a down payment, it's 6.7. If you want to receive an additional 2% with CalHFA, the rate jumps up to 7.25. So it goes up 0.5% higher for an additional 2% with CalHFA. With GSFA, it's a little bit more favorable. We can start at 6.5%, and then to get an additional 2%, if you want the 2% grant, the interest rate only jumps up maybe by 1/8. So it's a little bit better terms, more favorable. Pros and cons, right? That would be like one of the things that we look at, is that the rates are more favorable. One of the things that may not be attractive to a client is that it is not a deferred loan. You do need to pay back that 3.5% in your mortgage payment. And by doing that, your debt to income ratio gets a little bit tighter, right? But there are more flexibility in CalHFA. Also, to another big thing is that you don't have to be a first-time buyer. Like other programs, you need to not have owned a home the last 3 years to be considered a first-time buyer. With this program, if you just sold your home last year, you can still qualify. If you co-sign with somebody and you can show us proof that you're not making the payments, even if you lived in the home, you're still qualified as a first-time buyer. You can also bring a co-applicant that owns a home and can participate with you, and you will still be eligible as a first-time buyer. So if a client co-sign with somebody who lives with the parents and they co-sign with them and now they want to buy their home and they want to qualify for a first-time buyer program, most other programs would not allow them to purchase, but this program does. Okay, so there's also no limitations on how much money the client can bring along with the program. Perfect credit's not required. FICO scores as low as 640s. You can qualify. With other programs, you need 680. Okay. Debt to income ratio too, this one you can go up to 50%. With CalHFA program, you can only go up to 45 if your credit score is under 700. With this one, with the 680 credit score, we can go up to 50%. So there's, this is when I look at both options to see if my client could qualify for more. Another big plus is that other programs are only for single family residents. With this program, we can go up to 4 units on a conventional loan. Okay, so up to 2 units with FHA because we don't need to go through the income threshold. 4 units is more favorable with conventional loans if you're putting a 5%. So that's kind of like a scenario I would run, would be a 5% if the clients have their own money, plus give it another 3%. That adds on and keeps their loan amount low, monthly payment low, DTI low. With housing being so expensive right now, we are starting to hear more people inquire about multi-unit living. And we know that's expensive. We know that it's really hard to find multi-unit homes in a lot of these neighborhoods because most people that have units, they're not selling them because of the rental cash flow. But there are a lot of opportunities outside of the area. So there are a lot of opportunities within our communities that we could place people into multi-units. So, the market's tough. We are handling calls every single day that come in through different resources from our systems. And everybody's question is affordability. How can we get into a home that we could afford? How can we pay under $4,500? How can we pay more than $2,500? So that's becoming a big obstacle, and it's been a big challenge for the last few years. And I think thinking forward, it's going to be harder and harder for us to get people to qualify for homes. As you already probably heard the announcement about interest rates, they're going to stay the same. And what does that mean? We're going to be quoting 6.77% rates for probably the next 6 months. We went from the beginning of the year, 5.7, FHA loans, 5.6. I don't know if you guys remember that, to now, quoting 6.25, 6.5. That's a big jump on monthly payment. So, I think our job as lenders is to find solutions for our consumers. To reach out to my agents, inform them what's happening. How can we, use financing, use these options to be able to create more opportunities for consumers. And it starts with you. People come to you, more than they come to us because you guys have the property. They look at the property. They want to know the monthly payment on the property. So you can help me, promote these programs. You can help me navigate through every single client's financial situation and figure out what is not just the best fit when it comes to their finances. That's my job. But also the type of property that we can get them into to be able to resolve a lot of these challenges when it comes to real estate. So, one of the ideas that I gave to one of my agents this week was, if housing is becoming the biggest challenge for consumers, if people can't afford their monthly payment, then we need to really change what housing looks like for a lot of consumers by maybe advertising different types of homes, right? Whether it's a condo, whether it's a multi-unit, whether it's home with EDUs, how can affordability, look like in these type of homes versus the ideal single family residence with the white picket fence in the front yard? Unfortunately, we're not in the market that, that dream of first-time buyers, it's a reality anymore. And we have these conversations all the time. People are asking us, we want a house, but we know the payment is too high. What options do you have? And, and I'm being very transparent, letting them know, like, maybe look into condo, multi-units. Has anyone talked to you about multi-units? And most of their answers are no. No one told us that buying units is even a possibility as a first-time buyer. They think that in order for them to buy units, they need to be an investor. They need to have large down payment. So that is something that people are hearing out there. So, maybe working your marketing around selling multi-units might be, or single families with ADU might be a way to switch the American dream for our clients when it comes to housing. So, a lot of times people think they also need to be on their low moderate income limits to qualify. So the income limits are very favorable. They're like CalHFA, which is about 214,000 per year per household. And that doesn't mean, everyone, we count everybody's income. It's just whoever is going to qualify for the loan just needs to meet the income limitation. Multiple first mortgage loan options are available too, like FHA, VA, USDA, conventional financing. Now, the difference between Fannie Mae and Freddie Mac is the different types of programs that they're offering for first-time buyers. GSFA is a Freddie Mac sponsored program. So all the loans that get funded through GSFA are Freddie Mac. And what that means is that the DU, it's an LP, not an automated DU system. You're going to receive an LP from me. So if you receive an LP finding, it's because we're using GSFA program. And LP, unlike DUs, are very different. And when it comes to credit, they're more flexible on credit, which some of them are not going to fly to conventional loans. They're going to be more flexible when it comes to condominiums and credit as well, and multi-units as well. Okay, so when we use LP, everyone uses DU because typically that's 90% of our audience is going towards an automated approval through DU and conventional. However, LP does work for a lot of our clients when they have credit that's limited, when they're buying multi-units, when they're self-employed and we only want to use 1 year income. And this is when we're using LP and we're funding our loans through GSFA programs. There's also purchase limits. Okay, we just want to make sure that we cannot go over $832,000 on the first mortgage with GSFA. Unlike CalHFA, you can go up to $1.2 million. So there are, purchase limits with these programs. And it can be anywhere in California that they could apply. All right. Now, one of the common questions that we have with the program is that one's occupancy, it's the big one. And then 2, resident status. So just make sure that, a lot of our times obviously ITINs is out of the questions for any Fannie or Freddie programs, but Fannie does accept, temporary visas, work permits, people that have, dreamers, work authorization. FHA does not. Okay. GSFA also does not accept certain types of visas, and they don't accept work authorization for dreamers. So one of the first questions we're asking now with everyone that's applying with us, if they check off, they're not US citizens, we're trying to see like if they would qualify for a Fannie, Freddie, or FHA loan. Okay, so that's one of the things internally that we're, always questioning our clients. I just wanted to kind of cover that because a lot of times you might get a client that says, what, I only have a work permit here and I read about this program. We'll answer that question for them, but in case you run into someone and you want to lead them the right direction, just know that GSFA program with Freddie Mac, they do not allow dreamers and certain visas, unlike Fannie Mae. Another big question is, I've owned a home in the last year. Can I use this program? The answer is yes. Also to remember, if they co-sign with someone, they can still use this program. They're moving out their parents' home and they co-sign with the parents, they could use this program. So if they are planning to leave their existing home rented and they want to buy a new home, they can use this program as well. Okay. They can also use it for applicant that owns a home. So that is a big, big plus because a lot of times people want to qualify for first-time buyers, but their parents own a home and that disqualifies them from 90% of the programs. But with GSFA, it does not. So we can take advantage of this program with them. All right, so that's kind of wrapping it up for me. I promised you guys 30 minutes. Any questions on this program? I want to kind of go over to a little bit where you can get a lot of content and information on the marketing. If you want co-branded flyers, just send me a message. We'll be more than happy to send them to you. If you're already set up with a total expert, the marketing flyers are already in there. There's content already created for you that you can use. GSFA also has a a lot of content on their website, so you can go there directly. There's an actual icon for realtors that you can actually see in there what it looks like and how to market these programs. I recommend everyone to start just kind of plugging in videos to TikTok or videos to Instagram of how this program can help you get into a home. And I think the big takeaway from this one is promoting units. Okay, I think the unit part of it, giving that extra 75% of rental income for a duplex makes a huge difference on the qualification for a buyer. And we're not doing that enough, right? And again, it starts with you. You're promoting a property, maybe going out there getting a duplex or a triplex, or promoting what that cash flow will look like for a client, how they can qualify, and how they can receive a grant. Clients have a little bit of money out there, and some of them are withdrawing their 401ks to purchase homes. And a lot of times we're doing the math together with them. And we're saying, well, if you're borrowing your 401k and you have to pay back 6% of interest through your paycheck, what is that going to do for your finances at the end of the day, when it comes to your take-home pay? Versus applying for these programs, you're going to repay it back. The interest rate is lower. Some of the times are deferred. Does it really make sense for you to pull out your 401k? Does it make sense for you to get these programs, especially with the grant money? That's huge. 2% free money. Why not? It helps them offset closing costs. So it's about structuring and putting, an ideal situation for a client and really asking the questions. And a lot of times they tell us, we have $40,000. We're like, that's great. Do you want to use it all? They say no, really want to use 50% of it. So this is where we asked them, would you be open to looking into down payment assistance program? And that's how, it's going to help. Now, here's the thing about down payment assistance program that perhaps our clients kind of, push back and say, well, that's an expensive closing cost estimate. Unlike traditional conventional loans have, their closing costs are average about 2.5%, right? On down payment assistance programs, the closing costs can be anywhere from 3.5% to 4%. And the reason why is that with these programs, the lender charges an upfront origination fee for them. And because there's no servicing rebates for us, there's no servicing funds are getting paid through the back end for us. These are government agencies entity, and these are nonprofits are giving us the lowest rate available out there. They're selling their loans only to one investor on the secondary market. They only have one servicing company that it's, servicing the loans. So because they have these contracts with servicing companies that are able to fund the loans at the lowest market rate that's being advertised online to consumers, the lenders need to, just like realtors, charge their commission upfront to the consumer. So the origination charge may seem really high. And the way I explain it to the clients, really simple. Today, Wells Fargo is promoting a 6.875. We're offering a 6.25, but we're charging an upfront fee for that rate. This is how we're getting paid. This is how the bank's getting paid. But overall, the program is giving you back the money to cover those charges, right? A little bit like a mortgage broker, but with lower rates. The closing costs are being covered by the agencies to be able to offset the benefit of you receiving a lower rate. So once they hear lower rate, low monthly payment, the benefits to it, and they compare them apples to apples. At the end of the day, when you look at two estimates and you break them down, even with the origination charge, the out-of-pocket for the consumer, it's about $15,000 less with a GSFA or a CalHFA program versus a traditional loan, right? And the big wins are less out of pocket, lower interest rate, in this scenario, grant program. You're repaying back the second loan on this program versus CalHFA, you're not repaying back, it's deferred. So there are, advantages for these programs, and it's always good to compare them to see which one benefits the client. And just by looking at social media, a lot of people are advertising grants, grant money, down payment assistance, grant money. It is probably the number one search for consumers is how do we get this money? And we get a lot of leads from our systems because all we promote is CPA and GSFA programs. I have one agent that's all he promotes is GSFA programs. And I don't know if he is on our event today. He is not. But if you, I want to give him a highlighted kudos, but if you follow Jesse, the agent on TikTok, you can see his example of how he promotes GSFA program, and he is a lead generating machine. Okay. He generates so many leads just promoting to about GSFA program. It is his niche online. That's what he stuck to. He doesn't promote anything else but this. And we receive a lot of inquiries, and it doesn't mean everybody fits into this program, but it is a great eye opener for consumers. So if you guys have any questions about this program, you can send me a message. Any hands, anything that you guys want to input. Has anybody used this? I didn't get any raised hands. Are you going to use this program to promote in the future? I highly recommend you do. If there's any other programs that you guys have seen out there, have read about, people are talking about, please let me know. I would love to highlight that program in the upcoming months. But our next program is going to be Pathway that we're going to promote next month and provide also marketing material for you. All right. Well, everyone, thank you guys for attending. Any questions or any information that I covered today? Right. Well, awesome. Well, thank you guys for tuning in. I will hope to see some of you at the Tom Ferry event next week. If not, just send me a message. If you have a scenario you'd like for me to run with your client, send the information my way. I'd be more than happy to assist them. And again, some people are not ready. They just want scenarios, and that's okay. We can share that with them having to submit an application. And I think that's really important that we make our clients feel that they can reach out to me without any commitment. They can reach out to just have a conversation without having to fill out an application with us. All right. Thank you guys for joining. Enjoy your weekend. Stay cool. Enjoy the rest of your summer. Okay. Bye-bye.